Understanding Leasehold Improvements, a comprehensive guide. Leasehold improvements play a pivotal role in the realm of rental properties, particularly in commercial real estate. Whether you're a landlord seeking to attract tenants or a business owner looking to create a customized workspace, understanding leasehold improvements is crucial. This article delves into the intricacies of leasehold improvements, their financial implications, types, and significant rules governing them. What are leasehold improvements? The term leasehold improvements refers to the modifications and enhancements made to a leased property to meet the specific requirements of a tenant. These alterations can range from simple cosmetic changes like painting and installing new light fixtures to more complex renovations such as adding partitions or upgrading flooring. Importantly, these improvements may be initiated and financed either by the landlord or the tenant, depending on their agreement. Key takeaways. Leasehold improvements are tailored to meet the unique needs of a tenant. Both landlords and tenants can undertake these modifications. Common examples include painting, partitioning, and replacing flooring. Major structural changes to the building, such as adding elevators or expanding the building's footprint, do not qualify as leasehold improvements. How leasehold improvements work. Often known as tenant improvements or build-outs, leasehold improvements make rental spaces more appealing to potential tenants. These improvements are typically negotiated as part of the lease agreement, with conditions that also specify ownership post-lease termination. By default, improvements generally remain with the landlord unless otherwise stated in the lease. Most critical to note is that leasehold improvements must fulfill specific criteria to qualify. Modifications must be made to the interior of the property. They should accommodate the needs of a specific tenant rather than serving a general purpose. Improvements should not alter the structural framework of the building or introduce exterior features. Tax implications of leasehold improvements. Leasehold improvements have unique tax classifications, making them qualified improvement property for tax purposes under the Tax Cuts and Jobs Act, TCJA, of 2017. Important tax considerations include: improvements should be made after the initial property service date. They cannot include structural changes like new roofs or HVAC systems. The IRS allows for depreciation on leasehold improvements, provided specific conditions are met, allowing landlords to recapture a portion of their investment over time. Depreciation methods. 1. Internal Revenue Code, IRC. Under certain conditions, leasehold improvements can be depreciated over a 15-year period. 2. Generally Accepted Accounting Principles, GAAP. Improvements are amortized over the shorter of the useful life or the remaining lease term. Types of leasehold improvements. Understanding the different types of leasehold improvements can help tenants and landlords negotiate effectively. 1. Tenant Improvement Allowance, TA. This gives tenants the responsibility to manage and oversee the improvement project, relieving the landlord of that burden. The landlord typically sets a budget, either as a lump sum or a per square foot amount. 2. Rent Discount. Landlords may offer rent concessions to offset the cost of leasehold improvements, such as reduced rent for designated periods. This helps tenants financially while motivating them to engage in improvements. 3. Building Standard Allowance. Here, landlords propose a standard set of improvements that tenants can choose from. This approach allows for a more streamlined process, as the landlord manages the project. 4. Turnkey Improvements. Landlords implement this type at the lease's inception, handling all work based on estimates and designs from the tenant. It's an efficient way to ensure the space is ready before the tenant moves in. Legal and tax rules regarding leasehold improvements. The legislative landscape surrounding leasehold improvements has shifted over the years. Notably, the Protecting Americans from Tax Hikes, PATH, Act introduced a permanent 15-year recovery period for qualified leasehold improvements. The TCJA further refined the rules, lifting restrictions on the relationship between landlords and tenants and removing former qualification timelines. The CARES Act, enacted in 2020, established favorable conditions for claiming deductions on qualified improvement property, enhancing financial relief options for affected businesses during economic downturns. Leasehold improvements versus building improvements. It's essential to distinguish between leasehold improvements and building improvements. While both involve modifications to a property, leasehold improvements are tailored for a particular tenant's needs and may not benefit others in the building. Conversely, building improvements, such as roof replacements or HVAC upgrades, enhance the overall structure's value for all tenants. Conclusion. In summary, leasehold improvements are integral to customizing rental spaces to meet tenant requirements. While they represent a significant investment for landlords, these improvements attract tenants and can enhance the longevity of rental agreements. Understanding the nuances related to these upgrades, including tax implications and types of allowances, can empower both landlords and tenants to make informed decisions that benefit their respective interests. By leveraging favorable lease terms, understanding depreciation methodologies, and recognizing the differences between leasehold and building improvements, all parties involved can foster successful and sustainable rental agreements.